Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, October 8th, 2020. We'll do a quick update here on the markets, particularly NQ, Nasdaq 100. That's where a lot of my focus has been recently. And I realized shortly after wrapping up yesterday's video that I didn't do updates on natural gas and coffee, which were two of the commodities I've been watching lately and highlighting. So I'll do updates there. So we'll keep it quick. And again, if you're watching this video, you've probably already read today's post. I put a post out right around the open today. That's that big level, give or take, about 11,550-ish, and that has been the level since our sell signal back here in what was that, back in the second or third, I believe, that set off this downtrend and has capped every rally up to that level. Has seen the Nasdaq 100 reverse so far. That won't happen forever. And something I point out all the time is that when you have trading ranges, typically the longer the market's in a trading range, especially a tight trading range, well-defined, well-watched, it tends to act like a coiled spring with the market building energy. And so once you finally break out of the range, not always, but often you can have a pretty strong move depending on which way that range breaks. So really the most recent range we have, it's gotten a little tighter right here. There it is. There's the box I keep drawing, and so that's it. And like I said, one thing in trading I will guarantee, there's very few guarantees. About the only guarantee I ever give is that you will lose money on this times. All your trades won't pan out. Nobody bats 1,000, not even close, but you don't have to bat 1,000. Trading is all about looking at objective entries, long or short, and then using an attractive risk-reward ratio. So if you are a glass half full guy right now, or gal, meaning you think this market's going to go a lot higher, there's plenty of room to run, we're going to rally before and into the election, or whatever, just forget about it, just say the next couple weeks here, then you're looking for this. And what you can do is wait for the breakout. As I said here the other day, and as I said here, not objective to go long when you're at resistance. TA 101 says you do two things when a security rallies into resistance. You either, if you don't have a position, you either short, enter a short there, or you wait if you're bullish for a breakout. That's you don't go long right into resistance, you wait for the breakout. Likewise, the other objective time to go long is a pullback to support, and that's been the MO lately. Go long at the bottom of the range here, ride it up to the top, and go short at the top of the range, ride it down to the bottom. It's that simple. That's not going to work forever. Sooner or later, we're going to break up or down, and so, again, bullish or bearish, there's your levels. I haven't seen the market really this conducive to active trading in quite a while. For a while there, we're just grinding up. My updates in the markets cut back a lot. The market really, once volatility spiked, once we had this sell signal, we became much more conducive to trading. It's when volatility spikes that you usually get traders, for whatever reason it is. I've just noticed that when volatility spikes, that's when technical analysis really seems to shine. That's when traders are hyper focused and selling these well-watched levels. So there it is. Let's not talk much more about it. Like I say, if you're glass half full, you want to breakout. If you get it, convincing breakout soon, you can go long with a stop somewhat below in case that breakout proves to be a failed breakout. Like I said earlier today, if I take these divergence lines, if we break out anytime soon, let's say today, for example, take out those previous highs, start to run, I cannot guarantee it's going to fail, but I can tell you there's going to be some pretty big negative divergences, just like these positive divergences were the catalyst for this rally so far, just like these negative divergences were the catalyst for this drop right here. So there it is. We'll have negative divergences. They could be burned through. What does that mean? PPOs keep going higher. If NQs keep rallying and burn through these divergences, that is a possibility. As of now, I'm just keeping things simple. Why overly complicate it? Again, another objective time to either close longs that you took the other day on the bottom of the range, right here on the last tag, and or enter some short trades with a stop just above. That's my preference right now. And again, trading ranges don't last forever, so watch for a break, either solid convincing break above or below the this trading range here for what may prove to be the next, tradable swing trend, other than within this range. These are very short term, I mean 1 or 2 days. And that's the thing too. This is about a 3 to 4% trading range. If you trade futures, if you trade NQ or even the E-minis, MNQ, that's great to get your feet wet. It's 1/10 of the leverage factor, I believe, than the regular NQs. I don't have to tell you how much money you put in your pocket by catching even a good part of a 3%, 4% move. So an active trader could have made a lot more money in the last week or so here, even on the last few times once this range became established. I mean, the resistance was already established here, so it was pointed out there, and there's been plenty of ops to short there. So again, it's right now the market's more conducive to active trading than it's been in a while. Not so much swing trading. Swing traders have gone sideways for a while. Let's look at QQQ. All right, so you know where I think we're going there. What to watch for? There's an uptrend line slightly breached right now, but let's see if we have a solid 60-minute close below that. Let's go to QQQ. Recently, let me flip over to 60-minute chart. And I think it was last week I covered this chart here where you had the sell signal right here back in, again, early September, right there on the breakdown of that trend line there, and that set off a downtrend. And a downtrend is simply defined as any security making a series of lower highs, which I'm circling there, and lower lows. So we were in a downtrend, and it's not just random coincidence, but that downtrend ended with positive divergence. As I said, this was, and I'll still maintain, by far the most bullish setup I've seen in the equity indexes since early March, when after that big COVID drop. It's the first time I've seen clean, and comparable, nice big positive divergences. So again, it's wash, rinse, repeat stuff. Divergent high was the catalyst, technical catalyst for this correction. That divergent low so far has been the technical catalyst for the uptrend that we're in. So this is what I wanted to point out. So that was the low, divergent low, and since then we've been in a near-term uptrend, and that is a series of higher highs and higher lows, which I'm circling here. That one's right there as well. So there's your series of higher lows, higher highs, and I don't want to put too much into this. If you take out this previous high, I'll just have to say, looking at this, just on face value, that will keep the uptrend intact. I have warned, however, again, if that happens soon, and really technically speaking, you just have to have an equal or higher high. If you want to split hairs, I mean, we're not there yet. When I zoom in real tight, you can see on QQQ, I'll put a horizontal line here at the top of this candle. That's the candle, I'm sorry, from Thursday. That's the high. Again, if you want to get very technical, QQQ has to take that out or equal that. But for all intents and purposes, we're almost there. And maybe if I turn on here, I'll try it. Let's just see for kicks and giggles here. If the after-hours session, if we hit it, no, close, but not there. That's just that shaded area. I just want to see the after-hours. This is why I like to use futures as well. All right, let me turn that back on. Okay, so where I'm going is, yes, we're in an uptrend. So you can certainly make a case to buy dips if you're a bull until the uptrend is over, and it's not yet. So what I'm looking for here is a solid break above the that previous high, especially if these divergences get burned through. Like I said, I'd be skeptical of a breakout because of the divergences. I would be much more apt to cover shorts and go long on a breakout above these recent highs if we didn't have the negative divergences. But as I just showed you before, here and here, I put a lot of weighting into that. There's many other factors that go in. That's not the only thing that goes into my analysis, things I've covered on the longer term charts and everything else. So very near term, let's get a little more granular. We're on a 60-minute chart. Let's drill down. Let's go down to let's say a 15-minute chart. Let's do this. Let's go down and turn off all these lines. We can even go to a 5-minute. We can do that. Yeah, sure. Let's turn off the lines. All right, so here's what we're looking at on a 5-minute chart. We can see right here, there's a gap. I'm going to box it in right here. Gap right there. And that was in a reaction high there. There's our previous high right there. So these are levels to watch. I don't have as well defined an uptrend line. I gave you one on NQ today, which if we go much lower, we're starting to crack it. I mean, as I was doing that video earlier, we were below it. If we get a solid move down, a solid 60-minute close, that will be a sell signal. It'll be a break of that trend line, and also a failure so far at that other high. And then here's the the bottom of the recent range. So again, here it is. We're boxed in here. There's a gap right here. You can even draw some minor resistance there. There's another gap right there. But I'm probably going too granular for most here. You can try to micromanage trades. You can look at these reaction lows and all that. But again, I think right now keep it simple. Whatever's been working lately, and that is recognize the trading range for what it is, and be long at the bottom, short at the top, cover very short. And like I said the other day, you don't always get a push all the way to the top. You don't always get a push all the way to the bottom. A lot of eyes are on this trading range, and as such, if you are riding this down, let's just say we're not going to go down and take it out. We could reverse just shy. What my preference will be, I'll tell you right now, if we do start moving down, we get anywhere close to the bottom of the range here, other than you could certainly take profits at the bottom of the range. There's nothing wrong with that. But if we get another failure, another move down there, I'd be more apt to just set a stop when you get close and let it run in case you get a breakdown below the range. And the same thing in reverse for those that are bullish or want to go long or are long now is, set your stops appropriate, especially if you get a breakout above the top of the range. And you might want to let it run. That's going to be, like I said, there's a lot of fuel that's been built up here recently. So an upside breakout has the potential to rally the Qs, maybe back to and even above the previous highs. Oh, and I wanted to do a quick update before we move away from the indexes on the small caps, because I do think if we reverse here soon, if the large caps fail here at resistance, or we have a false breakout, a little whipsaw breakout, and then a failure and another leg down, I think our small caps may could outperform to the downside, or at least keep up with QQQ and NQ. And what I've done here is added a couple lines. This is resistance right here. We had a reaction high there, so it's more of a resistance area. It's not hard resistance, but about 1592. We popped it the other day. We fell back down below. We're back above now, but look what happened. We had divergence there at that high, and that divergence continues to extend. This is a marginal new high. So that divergence line was here the other day when I did the last video. Now it's here. That's where it was, and you can see it's starting to steepen here on the PPO. But as I always say, divergence is not a sell signal. What's a sell signal? Well, a break of support, a bearish pattern. So now we're starting to get a pretty clean uptrend line right here, like we have on NQ. So you want to look for a break of that. And then, bullish scenario would maybe have a back test of the 1592-ish level, and then a move higher that might take out the divergence. Whereas if we fall back through there, that would be quite bearish, and I think we'd see a pretty good move down in the small caps. So this is again RTY, the small caps futures. M2K is the mini version. So again, if you want to get your feet wet on futures and you don't like the high leverage factor in the RTY, you can use M2K, or of course IWM, and there's all the different leverage 2 and 3 time leverage ETFs if that's your thing. Okay, coffee hanging in there. It hasn't yet really taken off, but the charts are still constructive in my opinion. You had, again, you can see all here, these divergent lows, some positive divergence right there. Divergence is not a buy signal, but a breakout above a well-defined downtrend line is. So that was it. We went long there on coffee. We caught the bulk of that run. And then that run set up a beautiful uptrend line, nice and clean, nice clean negative divergence, telegraphing a likely trend change, which again, the divergence wasn't the sell signal, but this breakdown was. It was impulsive, just like the breakout was impulsive, everything you want to see. So now we've come down. I highlighted recently we had some decent support around 108.60. We had a pretty couple whipsaws through and around it, but we're above it as I speak. And we also have this downtrend line. I added this the other day, minor downtrend line, and so we're back testing both that minor downtrend line, which we just broke above, as well as the 108.60. It's been choppy. We're not really running yet, but as of now, still constructive. And same story. Probably have a stop somewhat below those recent lows, and that's KC. Now you can trade JO. It is an ETN, so it's not going to do a perfect job of tracking, but it's your only alternative. Somebody emailed me the other day asking about contango. Randy, what's the deal with these commodity ETNs? And yeah, they do suffer from contango, which is when they're trying to track futures. That's what Joe is doing here, tracking coffee futures. I prefer to trade the futures. I know a lot of people don't have access to futures or the understanding. They're a little bit more complex. Therefore, I cover these ETNs. And here's the thing: if you want to trade coffee, you have two choices. You're going to either trade the futures, KC, which I just covered, or JO. You're not going to go out on the open market and buy thousands of pounds of coffee beans and trade them and store them. That's just impossible. So my point is, JO does a decent job. Will it outperform some of the runs? A little bit. But I've actually, in the past, I've posted, I went over periods and done comparisons where we've had rallies and corrections in coffee, and I compared the futures to the CTN. I can tell you it does a pretty darn good job. So again, it is a if you don't trade futures, it's your only other option. Either if you want to trade coffee directly, futures, or this is not a bad alternative. It's not leveraged. It is an ETN, and some people are concerned about that. They're not always as secure as ETS, but again, you don't put all your eggs in one basket no matter what you're trading. So let's move on from that. And here's what it looks like on the 60-minute chart. Well, the line should be right there. Bullish falling wedge, positive divergence. Move down to support about 32.30. That's gap support. Here's your big old gap right there, and a breakout. So coffee, if I liked it last week, I like it even a little bit better today. And again, the story is it either pans out or doesn't. So you can take a long here, add to long positions with a stop somewhat below, and coffee's been trending. It's been a great trading vehicle. These rips and dips, best thing to do is swing these trends and get out. You can position longer term, but at this point in time, I'm just right now looking for the next leg up. So I don't have any hard targets. Each and every one of these levels is a potential target. So my preference, keep stops relatively tight and just let it run. Again, if that is your cup of tea or cup of coffee, I guess you'd say. Otherwise, let's look at another commodity for you. One that's even more volatile. Coffee's pretty darn volatile. Coffee's not so much volatile, it just trends. When it runs, it really runs to the upside. It's a very trendy, tradable instrument. It's one of my favorite instruments for years. We've had a lot of trades on the site on that. And natural gas too. Natural gas is more volatile, but if you catch a big trend, I can't think of fewer commodities that can put so much money in your pocket in short order or take so much money out of your pocket. So it cuts both ways. If you get on the wrong side of a natural gas trade and you're not diligent with your stops or disciplined with your stops, it can really, really hurt you in short order. I pointed this out the other day. We were up 10% in a day, and I've seen many, many days where natural gas goes up or down 10% or more in a day. So know your security is what I always say. And so if you're trading natural gas, you don't put the same amount in natural gas that you put in SPY or Procter and Gamble. You put a lot less because in just a few weeks you can make 30-40% on natural gas. You're not doing that in SPY or Procter and Gamble. So it's what I call beta adjusted position sizing. Take maybe half of what you put in one of those, because you need to allow wider stops with these volatile securities. If you don't use wide stops, they're going to clip you out in the noise, the day-to-day grinds. These ranges right here are pretty big. All right, so let's talk about natural gas. Okay, from a technical perspective, we have, I think you can see all the lines on my chart, but the most salient lines are this downtrend line right there, well defined. This is a bullish falling wedge pattern, complete with positive divergences right there. And we broke out recently, rallied up to that 2708. It was a target, it was hit, resistance. We pulled back, we hit it again, and then we made a back test of the wedge, almost a perfect back test of the trend line, and then rallied up. We fell a little shy. So far, we're making lower lows each time. So, however, we made a breakout and a back test. So if you want to take away this little micro analysis right here, those lower highs so far. Here's the way I would look at natural gas right now, especially for a swing trader. Bullish falling wedge, positive divergence, breakout, offering objective entry number one, quick opportunity for a quick trader to take profits, and then a back test. And so far we're above the back test level. So at this point we already back tested, so you can keep stops relatively tight, and there's support down there not too far below. That's probably low end area for a stop, and let it run up. And your next objective buy point or add-on, if you're not already long, would be a break above that level. That that 207, 2708 level, ish. Break above that would be quite bullish. It would take out these previous reaction highs, 1, 2, 3, and open the door up to that next target at 2915, as well as this intersecting downtrend line, maybe whichever comes in first, and they might come in around the same time. And then, of course, we get a reaction there or not. Whether we do, the next objective entry after that is a break above that level, and there's your next target. To wrap the video up, I wanted to do a quick update on that DKNG short trade I mentioned the other day. That one, this is a daily chart. We broke down big divergences right here, negative divergences. We're about halfway or more to the first target. These are unofficial targets, so it's unadjusted. Cover a little bit above that if that's what you're targeting. Now, at least one member told me that he had taken this trade, and what I said is these additional potential downside targets are only likely to come into play if the rest of the gambling stocks break down. I listed some casino. This isn't a casino. I'm sorry. Yeah, this is not a casino. And so what you want to look at are, well, there's a list I have of other gambling stocks. Some of these have physical locations, some don't. You have Churchill Downs, CHDN. You need to see a lot of these other gambling stocks break down, and I don't have them all marked up, but you can see a lot are in uptrends still and have yet to break down. Negative divergences in place. Some started to move down, but I really want to see a broad-based sell-off. More of these moving down, especially more of these breaking these support levels that I'm giving you there, the uptrend lines. There's one that's been in a downtrend for a while. So I'm just rifling through a watch list of gambling stocks, and it's kind of a mixed bag. So the point with DraftKings was, I still maintain at least this first target right there. If you are micromanaging this trade, this is what it looked like on the 60-minute chart. I believe I already shared this. You had a nice, clean, bearish rising wedge on the 60-minute chart. Breakdown, plenty of time to enter. Some breakdowns occur in a big gap, and you really don't want to chase. This one broke down and moved down steadily, hit that first support level target there, stopped right above it, then gap down the next day. Support once broken becomes resistance, so we rallied back up to that level. I believe I showed this last week or earlier this week, and that was another objective short entry on the bounce back to resistance, and it's been moving lower since. So it stops you could lower right now a little bit. I'd give it some room. This is a volatile stock. It can move 5% or more in a day. If you're trading this 60-minute chart, there's your next target around 48 and then 44. So those are the levels I'd be looking at now. But again, watch the other gambling stocks because this one's probably only going to go down so much without the rest of the sector going down. Okay, we'll wrap it up here. There's QQQ. So far, again, day is very young, I need to say that, but so far this is the open right here. This is a 1-minute chart, and it opened right into resistance. Again, wash, rinse, repeat. Like I said, I can't promise it'll work out, but I can tell you that's the best shorting op I've seen since the last time we were at the top of the range, and we dropped 0.61% so far. So they're fading that. You have a little minor support right here. Be nice to see that level go about 280.68. Of course, yesterday's low, or the gap, there's your bottom of the gap. This is the gap right here. When I refer to a gap, we closed here, we opened up here, so there's your gap right there. Watch for a gap backfill. If that does happen, the bulls should step in and run it up. If they don't, then that's obviously bearish, and that's going to increase the odds that we're going to continue down towards the bottom of the range if, again, that gap support around 280 goes. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.